Alright folks, this is going to be our algorithmic discussion in lecture for model number 6, universal trading, specifically dealing with the buy-side low resistance liquidity runs and fractals. Alright, so obviously without going through all of the details as I've already done in the previous videos for this model, in the time that you've been spending with me, obviously you can see that there are lots of market maker sell models, market maker buy models, and because they're fractal, that means they can appear and form on any time frame, but without the logic of the narrative. Why should it go up to a specific level? Okay, we're looking at a market maker sell model here, and there are two stages of accumulation. When I'm looking for a price run from whatever the market price would be, and say I'm bullish, the first thing I'm doing is I'm going through the time frames highest to lowest, and I'm looking for some kind of narrative that would be utilized for the price to be drawn up to a specific key level as a form of a premium array. Now, if I go into the marketplace and I'm looking for shorts, and I have room before where the market price is at the time of me sitting in front of the chart and where I think the market's going to create that short entry, if there's enough range there, I'll always consider using the buy side of the curve of a market maker sell model. That's basically like the blue shaded area here. And I may not get the first accumulation. So what I'll look for many times is the second stage of reaccumulation that sets me up a run up into that premium array. There's examples of me on my YouTube channel. I used to do it on YouTube and have since deleted some videos, obviously, because they had music in them. Back in the old days, when on Twitter, I would show examples of me buying and selling the same instrument. And it was me using what I'm showing you here. Okay. So it's not a matter of me getting in front of you with a chart and walking you through it, because there's so many examples and so many variables. This is why I dubbed it a universal trading model, because you're going to learn over years of experience. Okay, even if I showed you an example every single day, it still won't scratch the surface of the flexibility knowing how to read price and utilizing this framework will give you. If you're looking at, say, the market's trading here, and say it's the S&P, okay, I used this idea this morning with the S&P E-mini futures June contract for 2022, and accumulation, reaccumulation up to a premium array. Now the problem I had at the time was I was not sure exactly where the premium array was, but I knew it was going to draw up higher because we were failing to make a lower low, and it should have broke at 8:30 news and tapped into the sell side below the marketplace. It didn't do that. So I seen the shift in market structure, something to this effect, came back down into a fair value gap. It even overshot the fair value gap, but I was still confident that the trade would likely pan out because there was a reason for it to go to a premium. We were already at a discount ahead of the 9:30 opening for S&P. So I was using this framework here, accumulation, reaccumulation, but I did not know with any certainty as to what the objective would be on the upside. So I just used a nice easy objective, a fair value gap below an old high, which happened to get run out later on. So I didn't get the actual run highest exit strategy or price point, but I didn't need it. Okay, so I was using this universal trading model, model number 6, using the buy side of the curve of a market maker sell model. And that's a whole lot of stuff coming out of my mouth. But if you've been with me long enough, everything I just said makes sense to you. But this is also what I meant when we would get into algorithmic theory, because it won't help anybody that hasn't already gone through the content and studied and been with me under my wing for at least the minimum of a year. So I want to counsel you to go through all time frames each week. Like go through, find price runs that have a nice sell-off or a rally from them beginning at a specific price point, and then backtrack that and see if there is a market maker buy or sell model that's linked to that. And you're going to find that most of the time that's the case. So when we're looking at first stage and second stage accumulation before the turning point of the market maker sell model, you can use, for instance, that market maker accumulation phase here and hunt the YouTube model that is our model 13 entry strategy. Or you can use a simple fair value gap that's over here that's coming back down, and that's your long there. And the same thing here. So I want you to think about how you can utilize entry strategies with this premise in mind. But generally, you want to know where it's reaching for. Some kind of a target, some kind of a premium array. And I know that the folks that went through 2021 that rushed through it, especially the folks that paid an accelerated pace, they're not going to get that much from these videos. It's going to feel incomplete or disjointed. And it's only because you don't know what you should know before watching these videos. So in other words, the algorithmic theory videos are really like the conversation that I would have if we were having like a workshop for the full week. And each day I was teaching you components and ideas and how each thing fits together and what you should be looking for and what you shouldn't be looking for and how to navigate this and what to expect here and there. You should have things under your belt already. So that way when I'm casually talking about things and giving you my best advice for what you should have gleaned from all of this being under my mentorship is primarily that all of these things fit together. You can't fit them together yet because you're so new at doing this. But if you focus on the fact that you can't do it right now and you get frustrated with it, it will keep you from ever getting good at doing it. And you just got to continuously press into it, back testing, seeing examples, journaling. Okay, that's the number one thing, journaling and annotating your charts. So obviously the concepts work. Obviously this model is, the closest thing to what I'm actually doing in my trading without actually giving you my actual trading model. But this is very, very close to it. And you can see I absolutely lean on these teaching models to show you what I can with the language I've created without divulging too much. So when I show my examples, you can clearly see the logic in these market maker buy models and sell models. You can see the logic of me entering and pyramiding entries. Okay, when I'm doing more entries, except for times where it doesn't give me an opportunity to do a pyramiding. And when would that be? If we know that the market has already ran up, okay, and say I have a target or a premium array up here, and it runs up at least above 50% of the run from where I'm thinking the market starts its run to a premium, but it runs 50% of that, then it retraces. I'm going to assume at that moment that we're only going to have one stage of accumulation. That means I can't do any pyramiding. So when I'm looking at a run from market price to a premium, I'm anticipating this type of run here. But I need it to have at least two stages or I can't pyramid. So if I'm going long in here and then I get this long here, I can pyramid. Or if I go long here and it runs up and falls short and starts to retrace, then I can pyramid again because I know we have yet to reach the premium array for terminus. So I'm not trying to pyramid for the sake of pyramiding. It has to have an unrealized range still in the marketplace, meaning unrealized is like from here to the target I was looking for, or from this low to the target I'm looking for. That's unrealized range. So that doesn't mean that you are going to get that objective. It just means in my thought process, the inner dialogue is I'm looking for runs that will hopefully give me a fair value gap, institutional order flow entry drill, a short-term sell stop run, and then rally. So by having these ideas and utilizing what I've taught you from conceptual entry strategies to money management and also pyramiding, they all come together when you have the experience behind you to see them before they form. And it sounds lofty. It sounds, mythical. But you've seen many examples, and just, in the small little vignettes I do on my now Twitter account, again, you can see it. You can see the examples that I show on the YouTube channel, because I make those examples always public. There's never been any secret, private interpretations or examples shown just in the mentorship. Okay, I might amplify things that I've shown publicly, but I'm not really doing anything in here that's private, because I want every bit of the evidence I'm ever going to submit, it's going to be in public record. So when we have these moments where it gives you at least 2 stages of accumulation and we're bullish, you may elect to only trade on this side and may not want to trade short up here. That's fine. For the aggressive dynamo, okay, and I'm sure all of you, especially the young guys, are wanting to do that because you've seen what I've done, and it seems like elite, status, where you're buying, selling it near the high, and then shorting it, riding it down to a low, covering, and buying again, riding up to a short-term high. That's phenomenal trading, okay? I'm not going to pull any punches. To be able to do that, you're really dialed in. You aren't going to be able to do that right away, but utilizing what I've taught you, you can go and grow into that, measure of aptitude. But trying to rush to do it right away for the sake of being able to say, I can do it like ICT, or I can do it because, I'm better than everybody else, that shouldn't be the motivation. The motivation should be, can I find a setup that's repeating all the time from here or here to a level that repeats with my consistency? Am I able to find that type of framework? And if you only have one stage of accumulation here, you know that you're going to probably be in a parabolic price run, unless you're bearish and it's going to be in a hurry to get to that level just to go down. So that means you'll be pressing more on the sell side, which we'll talk about in model number 7's algorithmic theory. So using the examples from what I showed on Twitter this morning, May 31st, 2022, you can see prices consolidating in here. And I felt that they could have taken this high, but I was more interested in the relative equal highs here, admittedly. But ended up going above and sweeping that. So I was bullish because we did not take out the sell side here. We went down real close to it, and we had a fair value gap in here. So I was thinking, okay, I want to be buying in the fair value gap, which I did. My stop was just below the low. And it got close, but I was confident that it wasn't going to do it because it should have already ran it. And the fact that it was being very slow and lethargic about it, and it was ahead of the 9:30 opening. So 8:30 news couldn't push us down. Okay, so here's 8:30. We went lower here, and then we rallied up. Short-term shift in market structure with a fair value gap. Going long, stop loss below the swing low. That's it. Watch what happens, though. It rallies, offers me profitability. What's this? It's returning back to the original consolidation, right? So this is first stage of accumulation. You could be a buyer there with the expectation that we would run relative equal highs, or best case scenario, which I was not expecting. I felt it could happen, but my interest was really lying here initially. So you could be a buyer here with that target there. And here's second stage accumulation. Here, fair value gap, drops down into it, and then delivers to the premium array. And then what happens? The sell side of the curve begins, and it takes off and trades aggressively lower, taking out the original consolidation and digging into a deeper pool of liquidity. On the market maker buy model, focusing on the buy side low resistance liquidity runs and fractals, we're looking for instances where we've expected the market to turn down here. Okay, and as luck would have it, I have another example of that today. So the market trades down into a level that I think, or you'll interpret it as a discount. and then you wait for some measure of reversal. Okay, a shift in market structure, a low risk buy, and then accumulation, and then reaccumulation, second stage, and it runs to clear the original consolidation for that liquidity.